Listen up, traders. Oil just punched through its highest level in 8 months while you were sleeping, and the euro is bleeding out in real time. Euro to US dollar at 1.1706 is hanging by a thread, and most traders are about to get trapped because they're looking at the wrong chart. There is one danger zone and one hidden opportunity today. I will show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use right now. Write this number down on your hand or in chat, 1.1682. If we break that level today, the entire weekly structure shifts into full bearish collapse mode. Comment that number right now if you want me to call out the exact second it breaks. I am watching it live. Session bias is trending with strong sell conviction on every time frame from daily down to 5 hours. This is not a fade. This is not a range. This is a directional grind driven by real macro fuel, not just technical noise. The one invalidation level that proves this bias wrong is a daily close above 1.1816. Until that happens, every rally is a selling opportunity. Let me walk you down the chart from the top because this is where most traders get the story wrong. On the weekly time frame, euro to US dollar has rejected the 200 moving average 3 times in the last 2 months. That is exhaustion with a capital E. The weekly MACD just printed a lower high while price made a slightly higher low. Classic bearish divergence that typically leads to a 4 to 6 week down move, drop to the daily. Price is trading below all 3 major moving averages, the 20, the 60, and the 200. The 200-day sits at 1.1900, acting like a brick wall that has rejected price 4 times since March. Below that, the 60-day at 1.1820 has now rolled over. The daily MACD histogram has been printing lower lows for 7 consecutive sessions. Momentum is accelerating to the downside, not fading. Now the 4-hour chart is where the real action is happening. Price has printed 3 consecutive lower lows and lower highs, a textbook descending channel. The 20 and 60 on 4-hour have just bearish crossed with the 200 sloping down at 1.1780. The 4-hour MACD is deep in negative territory with no divergence whatsoever. That tells me sellers are in complete control. Here is what most traders miss. The 5-hour chart, and yes, I trade the 5-hour specifically because it filters out the noise of the 1-hour while staying faster than the 4-hour. The 5-hour shows price compressed right above the 1.1682 support level for the last 7 candles. That is coiling. Every compression on the 5-hour with a bearish moving average alignment leads to an expansion. And that expansion is likely to be a breakdown, not a bounce. Key support levels are 1.1682, which is the 61.8% retracement of the April to May rally, and then 1.1642, which is the February swing low. Key resistance sits at 1.1776, which is the 4-hour 20 moving average, and then 1.1816, which is the daily 60 and the level that would force me to reconsider the entire bearish thesis. Now let me weave in the cross-asset narrative because oil is the hidden hand here. WTI crude climbed another 1.2% in the last 24 hours. Every time oil rallies like this, the eurozone trade balance worsens by approximately 0.3% of GDP for every $10 move in crude. The market is waking up to this math. Yesterday's ECB speaker, Luis de Guindos, offered zero pushback against market pricing for rate cuts. Compare that to the Fed, where multiple speakers have said they need more data before cutting. That policy differential is widening, and the euro is the victim. Gold and oil are flashing the same inflation signal. Gold held above 2,350 while oil broke higher. That combination historically precedes dollar strength because the Fed cannot cut into rising commodity prices. The US dollar index just broke above 105.50 for the first time in 3 weeks. The S&P 500 is flat to lower, which means risk assets are not bailing out the euro through a weak dollar narrative. The 1 to 2 week directional lean is bearish toward 1.1642 and potentially 1.1550 if oil holds above 85. The exact event that invalidates this thesis is an ECB speaker explicitly pushing back against rate cut expectations combined with a weekly close above 1.1816. Until both happen, I am treating every bounce as a sale. Most people will skip this next part, but this is where money is made. Keep watching Strategy 1, the sniper. This is the conservative setup with the highest probability. Exact trigger condition is a break and retest of 1.1682 on the 5-hour chart. I want to see price break below 1.1682, then come back up to kiss that level from below within 3 candles, and then close back below. That confirmation pattern filters out false breaks. Entry is at 1.1678 once that retest confirms. Stop loss goes at 1.1710, which is 22 pips above entry. That stop sits just above the 5-hour 20 moving average, giving the trade room to breathe while keeping risk tight. Target 1 is 1.1642 for a 1.6 to 1 risk reward. Target 2 is 1.1600 for a 3.5 to 1 risk reward. What voids this setup is if price breaks 1.1682 but then closes back above it on the 5-hour without a retest. That is a failed breakdown and you stay out. Strategy 2, the active trader. This is for standard risk tolerance and uses mean reversion logic. Entry condition is a pullback to the 4-hour 20 moving average currently at 1.1776, combined with a bearish rejection candle on the 30-minute chart. I want to see price rally into that moving average, print a candle with a long upper wick, and then close below the midpoint of that candle. Entry at 1.1760 once that rejection confirms. Stop loss goes at 1.1820, which is 60 pips above entry and sits just above the daily 60 moving average. That gives the trade a clear invalidation level. Target 1 is 1.1700 for a 1-to-1 risk reward. At target 1 you take half profit and move your stop to break even. Target 2 is 1.1682 for a total of 1.3 to 1. Once target 1 is hit, let the runner ride with a trailing stop of 30 pips. Let me pause here. Let us see how aligned we are. Type your euro to US dollar range for tomorrow in the comments right now. I am reading every single one during the next hour. Is your range 1.1650 to 1.1750 or are you even more bearish than me? Strategy 3, the aggressor. High risk, counter trend on the smallest time frame. This is for experienced traders only who know how to lose small. Exact trigger condition is a momentum flash below 1.1682 that breaks by at least 15 pips down to 1.1667, followed by an immediate sharp reversal candle closing back above 1.1682 on the 1-minute chart. That liquidity grab often springs a 50 to 60 pip bounce. Entry on the close above 1.1682 with a market order. Stop loss is incredibly tight at 1.1670, just 12 pips below entry. Target 1 is 1.1720 for a 4-to-1 risk reward. Target 2 is 1.1750 for nearly 7-to-1. Explicit warning here. Only take this trade if you have executed liquidity grab setups before. If price breaks 1.1682 and keeps going without the immediate reversal candle, you do nothing. This is not a catch a falling knife trade. This is a very specific pattern. Never risk more than 1 to 2% per trade on any of these setups. No positions through the US PPI data release tomorrow morning. Stops are non-negotiable. If you cannot place a hard stop in the platform, you do not take the trade. Here is the one most critical level for the next session, 1.1682. Everything pivots there. A clean break with follow-through targets 1.1642 within 24 hours. A failure to break and a bounce back above 1.1720 shifts the short-term bias to neutral. Tomorrow's focus is the US PPI release at 8:30 a.m. New York time. If producer prices come in hot, the dollar accelerates higher and that 1.1642 level becomes real by the London close. If PPI misses, we could see a relief bounce to 1.1776. I will break down both scenarios the moment the number hits. If you want the full breakdown on Bitcoin and the S&P 500 divergence, why BTC is acting like a risk asset but funding rates tell a different story, that video is live now. Check the end screen, smash like if this analysis gave you a clear plan you can actually trade. Subscribe and hit the bell for daily coverage of all 8 assets: Euro to US dollar, Pound sterling to US dollar, gold, oil, Bitcoin, US dollar to Japanese yen with Nike, and the S&P 500. I will see you in the next 1.1. Last thing before you go. The euro is not collapsing because of Europe. It is collapsing because of oil and the dollar. Remember that when you see the headlines tomorrow. Trade the levels, not the fear. I am out.